Welcome to the Wealth Acceleration Podcast with your host, Wealth Coach Wade Reed.
Hey, what's up, Money Masters? It's Wade Reed here for another episode of the Wealth Acceleration Podcast. Today, we're talking about what is called the family bank strategy, sometimes called infinite banking, cash flow banking, banking on yourself. I prefer personally the term family banking because I'm a very family-oriented guy. And you guys hopefully know that about me. I've got 6 kids for that matter. Good grief, man. Stop having so many kids, right? Now, hopefully you guys appreciate that. The family bank strategy is really about unifying the family around the financial resources that you have. So husband and wife, of course, are obviously the primary decision makers. But as the kids get older, they can start to participate in understanding what money is, the value of earning a dollar, the value of spending a dollar, buying things that are of value versus things that break all the time. We want to train our kids to learn these lessons while they're young. We talked a little bit about learning some lessons in a prior podcast with my guest, Josh Mason. We want to teach our kids lessons while they're younger, and we want them to have a very healthy relationship with money. Now, perhaps your kids are older already. Well, you still have influence in their lives, and you can help them understand the value of setting money aside and not just depleting it when you buy things, but having a system for replenishing that money back into your life so that it can have a perpetual use during your life, but ideally also the ability to have generational wealth, transferring assets, financial resources, and most importantly, the values and priorities of your life through to the next generation so that they are also productive and perhaps even more productive and helpful to society than you were. So the family bank strategy, let's talk about what it is and how it works. We're going to get into this more. I'm going to have some guests for you this month with regard to this. It's a pretty comprehensive thing, so I'm going to have some interesting dialogue with some colleagues that I've worked with over the years. But I want to give you a basic understanding. Money, as I mentioned prior, it comes in 5 areas: physical, mental, spiritual, social, and then financial supports all those other things. So as we do the solution providing in our communities, in our work, in our businesses, financial resources come to us. It is a temporary store of value. Well, where do we store it? Typically, it's in a bank, isn't it? And banks have 4 main things they do. They gather deposits. They then lend out those deposits in the form of loans. For them, that's investing. For a business called a bank, how they invest money is lending it to other people. The third thing they do is get that money back with interest. That's the 4th thing, is with interest or with a gain. So when we use the term family bank, we're thinking about how do we apply these success principles of banks? How do I gather quote unquote deposits? My deposits would be contributions to a savings account. And then once it's in a savings account, how do I determine what the highest and best use of that dollar is? Of course, we have our lifestyle costs, and we're not talking about that. We're not talking about day-to-day expenses. We're talking about the surplus that you're setting aside that's intended to help grow wealth and prepare for retirement. So what's its highest and best use? That takes some discernment. That takes some thought and consideration and setting up some criteria. So let's talk about banks again to understand that criteria. Do banks lend money to anyone for any reason at any time? Guys, I spent 4 years in banking. The answer to that is clearly no. You can't just walk in and say, I need $100,000, and they'll write you a check that day. No, what are they going to do? They're going to check your background. They're going to do a credit pull. They're going to look at your debt-to-income ratio based on the total debts you have outstanding and the minimum payments on those debts to determine if your current cash flows. So that's another thing. They're going to check your income. They're going to ask you to verify that with W-2 or tax returns. And then they're going to evaluate your percent of total income to debt. That's the debt-to-income ratio. And determine if the new amount of money you're asking for and the length of term you're asking to repay it over is going to stay within a reasonable ratio so that you're not overextending yourself and causing a higher risk of not being able to make that payment. So based on the risk they perceive, and if there's collateral, like if you're buying a car, the car is collateral. If you're buying a house, the house is collateral. If you're starting a business, you might have equipment. That's computer equipment, desks, chairs, furniture. You may have some sort of like x-ray machine. You may have any number of assets. If you're in manufacturing, you may have manufacturing equipment, you may have transportation vehicles. All that stuff is considered possible collateral to back up that loan. The bank wants to get its money back. It wants to have a high likelihood of returning that money. That's referred to as the principal portion. The money they lend out to you is the principal, and then we repay a portion of the principal and a cost called interest through our payment. But the bank is not going to lend money unless they have a high likelihood of success. High likelihood of, I guess that's the right term. High likelihood of success of getting the money back. And their track record indicates that they're good at doing that. That's why they have the biggest bank buildings in the world. That's why they have the most access to funds in the world, because they're very, very good at what they do. They incentivize us, in fact, to give us their money, to let them hold on to it for a long period of time, and make it somewhat difficult, somewhat discouraging to get it back, because they give us a little interest. So they incentivize us to leave it there so that it can earn some interest. Well, my goodness, banks teach us to do the opposite of what they do. And to enhance the family bank system, we need to add in an asset that banks use. Banks on their executives, their key employees, also big companies like GM, Walmart, Microsoft, and all these big companies that have a long track record, 50 to 100 plus years. They are using whole life insurance contracts on their executives, key employees, founders, to assure that if those key employees pass on and they've had financial obligations to the families, they paid out bonuses to those employees, there's cost to replace that employee if they pass away, the death benefit replaces or helps replenish some of the money that is necessary to replace that person. So there's a protection aspect of having a whole life policy. But there's also this really interesting and valuable cash accumulation that occurs. The cash accumulation that's often referred to as equity in a piece of real estate or a car is called cash value in a permanent whole life insurance policy. And if you look on the publicly available balance sheets for these large companies and banks, there are over $200 billion of their quote unquote tier one capital. Tier one capital is the money that's necessary for reserves and for being available for the opportunity to enhance their business. It's liquid cash that's necessary to give them confidence that if something adverse happens, there's plenty of ability to deal with it. We likewise need to have that. We need to have an emergency/opportunity fund. It sits at the foundation of our financial life. And so if banks are going to use whole life insurance as a place to store their surplus and most precious capital for reserves and opportunities, wouldn't it make sense that we understand that asset as well and find a way to apply that in our lives? And that's what we do with the family bank strategy or infinite banking or cash flow banking. Family banking encourages us to accumulate money similar to how banks do, but then add advantages that come through whole life insurance. The advantage of the protection of the death benefit in case of early death. The advantage of the money that's stored in there being protected against creditors or bankruptcy situations if you get into a tough financial situation. The tax benefit of tax-free growth, tax-free accessibility, and tax-free transfer of those dollars at your death to your heirs. That's a huge deal. All these tax advantages that happen to come along with the asset of whole life insurance. Now, how we use it as a bank, remember banks gather money and then they lend it out. Well, the money that builds up in the quote unquote family bank, using the whole life policies as the primary place to store the money for the family bank, when we decide on an investment that matches our investment criteria that's highly likely to be successful, we can then borrow against, not from, but against the value of that life insurance contract. And when we use the policy as collateral, in fact, the insurance companies give us an automatic line of credit against the value of that cash value. That automatic line of credit allows us to access the funds at any time for any purpose, and then repay it whenever we want. There's no forced repayment plan. It's just like cash from your bank. You can take the cash out and go do whatever you want and then put it back whenever you want. Well, the insurance company has a line of credit so that it keeps the money in the policy, and the money in the policy continues to grow uninterrupted. Meaning, if you pull the money out of the bank, it stops earning interest. But if you keep the money in the bank, it earns interest. With the life insurance, you keep the money in the policy, you use it as collateral, and the money keeps growing. At the same time, you still have the ability to go do this other interesting investment. And now you've got two assets. You have the asset of the life insurance and all of its benefits, and then you have the asset of whatever the other investment is. It might be buying a rental property, it might be flipping a property, it might be getting into some sort of commercial or multifamily, it might be your own business for that matter, expanding the business, hiring an associate, opening a second location, acquiring a new piece of equipment that supports you in serving the community better. And then as that investment that you do starts to pay out a cash flow, or if it's just a capital gain investment, such as flipping a property, when the payout happens when you sell the property, you just simply replenish the money back to the policy. And whatever interest rate you were charged by the insurance company, that's already accounted for. And if you want to charge yourself a little bit more interest to make it more of an interesting scenario, you can pay yourself a little bit more interest back to the policy and enhance the overall pool of funds that are available for investment. And now we start to apply the principle of how banks make money. They gather it. They make very careful lending decisions out to other people with high likelihood of success. They get the money back plus growth. And they repeat and repeat and repeat and repeat. And if we can apply a similar strategy, that's what family banking is about. It teaches us and prepares us to be more successful with money. Now, let me give you some counter examples. I have many clients over the years who have thought about having generational wealth, but they also feel this sense of responsibility to their children to help them with education, for example. And I've got some clients where they have paid tens of thousands, sometimes hundreds of thousands of their own money for their children's education, with no indication that the children will have a need to repay the family, the parent, back for that investment in the child's education. Now, some of you might be thinking, well, that's perfectly normal. And in many cases, it is normal to help support our kids. But it's even better if we can train the child to recognize the value of the money that is being utilized. Because if you as the parent choose to invest in your child's education, you'll no longer get to choose to invest it in your own future for your own retirement. And oftentimes it's thought of as an expense as opposed to an investment. And remember, investments are supposed to come back with growth. So my point of view is that I'm training my children to think about the investment in a college education or a trade school or something like that that helps them enhance their skills that can solve problems in the community, that they're actually problems that want to be solved, that people are willing to pay for, that they can get a salary in a W-2 position or start a business and solve those problems. And the money comes back not only as just an income to them, but also the money that they get needs to be replenished back to the family bank. Because guess what? When I pass on, when my wife passes on, they will inherit the funds in the family bank. And throughout their lives, they'll have access to come request a loan from our family bank, saying, hey, mom and dad, I have this cool venture I'm considering doing. These are the criteria of this thing that I've researched, and it seems like it's going to be a really good fit. I'd like to take some money from the family bank to go do this. What would be the terms? And I want to train my kids to think about having a plan to replenish the money. And guess what? If something happens and that money gets lost, that's a big bummer. But because there's a guarantee of death benefit, at least at the end of our life, the money will be replaced. Because the death benefit's always higher, significantly higher than the cash value buildup. So if we use, say, $10,000 and it gets lost, I have $10,000 of less death benefit, but my death benefit was significantly higher than the cash value anyway. So my family's better off having had the death benefit than if we just had a bunch of cash and the money was lost without the death benefit to replace it at the end of our life. This is how large corporations are able to sustain 100 plus years in business, is because they have protections like this in place so that if adverse situations happen in their business, they lose employees, at their deaths, money comes back to help replenish the coffers and keep the business functional. They also have a long view. Rather than us thinking a few months out, business owners have the fiduciary responsibility to the business to think multi-years, decades down the road about how do we make this business sustainable? Well, our family unit obviously passes on at our deaths, but there is an ongoing children, grandchildren, great-grandchildren. So we're like a business. In fact, business is largely patterned after families. And if we can have a longer view of not just our life, but the next generation, we might think and act differently about money. And that's what the family bank strategy is about, is to help influence our thinking so that we're wiser stewards over the money that we have. So we'll make better decisions and less likely to waste money. So we have more coming on that, guys. This is just a primer on the family bank system. There's plenty more available. I'm going to launch some videos as well on this to help give some more training. But look forward to the next few dialogues with some of my colleagues as we talk about more in-depth practical applications of how whole life fits into the family bank strategy. Guys, thank you. Take care. Like, subscribe, share this with people that you love and care about. Help me reach thousands of people, and I'll see you in the next episode.
Thanks for tuning in to the Wealth Acceleration Podcast. We hope the insights from today's episode help you streamline your finances and grow your wealth stress-free. For show notes from today's episode and more tips on creating a comprehensive wealth-building plan, visit moneymasterycoaching.com. Remember, financial freedom is attainable. Until next time, keep accelerating towards your goals. See you on the next episode.